right in as soon as, Tom gives me the thumbs up. Okay. All right, so welcome to the Investment and Benefits Committee meeting. We'll jump right in and see if everyone's had a chance to look at the minutes from last time. Does anyone have any questions or concerns or comments? I printed them, but I can't seem to.
I see noted committee vote on allowing digital meetings.
Oh, great.
Was that not in the minutes? Like, is that something that needs to be added to the minutes, or is that already in there, you know? I just see on the agenda it has approved minutes and then has its committee vote on allowing digital meetings.
Oh, that's from
Was that not in the minutes that we need to add to the minutes?
Right.
did we not vote on?
I thought we did vote on it because, we had a resolution that was approved by the commission. So
So that needs,
Well, I'm just saying that needs to be added to the minutes before we approve them, if it's not in that term.
Yeah, I'm not seeing
yeah, I don't see it either. Okay, so do I have a motion to approve the minutes with the addition of the 1A vote on allowing digital meetings?
So moved.
Second.
Okay, we have a motion and a second. All in favor, say aye.
Aye.
Aye. That will pass 5-0. All right. Soltis, fiduciary governance.
Okay, thank you for having us, as always, we're glad to be here. The first thing I maybe just want to, I looked at Prudential's packet and ours. I don't think I've ever been to a meeting where our packet's the smaller one, so thank you, Kelly.
I don't know if we use thicker paper or what, but for some reason I looked at it too and I'm like, wow.
I will be excited that we don't have the largest packet in the meeting, but, thank you for having us. When we go to fiduciary governance, if we can turn to the business calendar on page 7. There's a few things that we wanted to touch on around fiduciary governance, including just some of the things that we're doing around that. One is we continue to update and build your fiduciary vault. That's the digital fiduciary vault that we have. It has all your documentation, processes, your investment policy statement, fee policy statement, etc. We continue to update that. It's been updated with our most recent trainings, as well as communications, so the fund changes that just happened with the collectives, etc. Those things. So we won't. And as we've talked in the past, that vault is digital. We actually do have a master hard copy that we keep as well at our office. But want to just make sure that we're reminding the committee that that exists and that we continue to keep that updated as we go through it.
On that item, could you add to your calendar the MAGDA training that we will be attending, and then
Yes.
maybe include those items in the vault? I think we want to document that training so that that's there.
If you have, typically for those type of trainings, we'll put in any content or agenda. So if we use just an agenda for the conference for a couple of days, just send it to us. We'll include that in there.
I think, Mark, you have that, don't you?
Yeah.
The agenda?
You're welcome to send us kind of whatever content and material you have from that training. So,
Tyler, can you, I don't know if your mic's on. Can you-
sorry, it's not-
That's okay.
It is now.
Great. Wow.
So yes, we'll, any documentation you have from that training send to us and we'll make sure and update the fiduciary vault. Okay. We have on here, and we'll plan to take some time, and I know that Kelly will help take some time there, but of course the 401A plan that was merged and that was completed this last quarter. I know there's some follow-up items just in terms of status and if there's any outstanding items, and we'll give Kelly, as obviously Prudential was leading in that, in the merge of that plan, so we'll take some time there. Around that, we have, in terms of additional fiduciary training, we'll have our third training for the year. It was scheduled for November 14th. We had to move the date up for November 7th for location, so we want to make sure the committee's aware of that for your calendar. You're going to get an invite from us, just kind of a save the date, but it'll be November 7th, Salt Lake City, same building that we've been in. We had to move it because that same building, I think a lot of our clients, it's a good location, and our clients know where it's at. That it was booked on the 14th, so we had to move it up just a little bit. And then another important item that we're planning to complete this quarter and report on in our next meeting is, as this committee I think is aware, every 12 to 18 months we kind of do a review and benchmarking analysis for the plans. One of the things that we have scheduled to take a look at is a plan design benchmark analysis. And actually Prudential has a couple of really great tools that we utilize in conjunction with them to do that. But what it does is it's looking at your plans and comparing them to your peer groups, so other government, counties, municipalities, et cetera, so that you can see what type of benefits, how your benefits stack up, how they look versus your peers, and versus kind of your category, as well as looking at some of the design features and things that you have in place there. So we're planning to go through that in the fourth quarter. That's something that we're working on this quarter, and going through now. I just wanted to bring it up with respect to if there's anything in specific. We have some limitations as we do that analysis, but if there were specific peer groups that you wanted us to look at, you in conjunction with, or specifics around your plan as we do that, whether it's your match, whether it's vesting, et cetera, those are things that we can certainly focus more on and spend more time on if there's any of those items that the committee would like us to spend more time on.
Yeah, I'm just, curious about other, counties that have opted out of Social Security, and, which is obviously a large factor in our 401 plan. And, the other thing I'd like you to look at is the waiting period.
Okay.
Right now, it's, 6 months on the match for Utah County.
Okay.
And, but I myself have not been that successful at finding, counterparts who have opted out of Social Security that are,
Yeah.
Comparable.
That's going to be a pretty smaller markup.
We're kind of unique, I think, and so I think that's going to be the challenge of that.
Yep.
But I'm very interested
Okay.
in this information.
Okay.
So
So we have, like I
Interested
said,
in that.
Prudential has great tools that we can use to look at that. We have relationship with other providers as well that we'll typically reach out to and say, hey, we're looking at this. What type of benchmarking data do you have? And then we'll compile that and go through it with you and be happy to do that. So.
great.
And just so you know, because I don't really talk about it, we don't usually have time, but on page 24 and 25 of my book, if you just want to jot those pages down, we do like a very high level, through plan sponsor and our own book of business, benchmark trends and participant behavior. So the two things that you mentioned, Ralph, weren't necessarily in this, but this will help you, maybe help you
Yeah.
build what you'd like to see from the things we put in the book quarterly. And this is done against county governments.
Yep.
Great.
So it does have some, but I'm sure what you're looking for is a little bit more robust.
Well, like I said, Prudential, we use Prudential, even though our clients that don't have Prudential, they've got some tools that we've used across the board with clients because they're good. One of the tools that they have, and I don't know if this is available in the public sector, but for some of our clients, Prudential can hone in, and we've had clients that say, hey, I want to see how my plan stacks up against these 4 or 5 companies because they're competing for employees in that space. And we can actually drill in, and Prudential's got good ability to do that. They've been able to do it in the private sector. I'm not sure if they have that same tool or analysis. It's through your actuarial team.
I mean, it's a really good question to ask.
Okay.
And we have a lot of government business.
Yeah.
So very likely that we would be able to put something together. That might not be, again, quite as robust as we have in the private sector, but we have a very large book of public sector. We have for other things as well.
Okay, great.
So we'll plan on the agenda and plan to dedicate some time and go through it. And I think that's usually a pretty productive exercise with respect to just overall where your plan stands, where you kind of sit in the peer group, as well as you're mentioning, Ralph, there's some things that you may open your eyes and say, hey, we have this 6-month waiting period. Most plans are immediate, or maybe they're a year. Do we need to, help communicate that or change it or those type of things? So, okay. The other item under fiduciary governance is the Secure Act legislation, and I want to just mention this again. I know that these plans are not ERISA governed, and this is legislation that's pending. It's passed the House, but it's waiting for a vote in the Senate. There's some provisions in the Secure Act around the age that you have to take your RMDs. There's provisions in there around MEPS, which really won't be applicable really to the county. But there's a number of things that are in that legislation that will be that we're advocates for. Actually, Kim and myself were in Washington D.C. just about a month ago, meeting with Senator Romney's office as well as Senator Lee's office, because this bill is sitting in the Senate. It has good bipartisan support. It passed the House 417-3, but they're just, you guys can probably empathize. They can't quite get the Senate to bring it to vote. Senator DeGrassi has said, I'm not going to consider it for vote until I have a unanimous vote, and there's a couple of senators that are holding out. But there's some legislation in there that I think will have some pretty profound impact on retirement plans, and so that's legislation that we're watching close. It's kind of been in the mix. There's been different iterations of it over the last year or two, but something that's there. And then the last thing around that I just want to mention is, while we were there in D.C., we had the Assistant Secretary of the Department of Labor that spoke with us. They are focusing very much on this, on finalizing and defining the fiduciary rule that was put in place under the Obama administration. Then it went to a period of observation, and ultimately the Trump administration ended up just eliminating it. But the Department of Labor has essentially said, we are going to look and impose their own rule. So the rule that the Trump or the Obama administration put in place was under the SEC. This one would fall under the Department of Labor, but they have said that they will have direction for us as to what that fiduciary expectation is for retirement plans in which they govern. And so that's another element around the, I think, legislation and guidance that we're going to receive from those governing bodies that will be ones that are important for us to know and recognize and understand what they say. Any questions on either of those?
No.
Okay. I mentioned the fiduciary training on November 7th in Salt Lake City. Again, each committee member will receive an invite from us, just with the date and location. We had on here the proposed ERISA budget. I know that we went through that in the last meeting. I think our expectation is that we will work with Prudential and kind of update that as we meet on a regular basis. And so it's in the packet, but I'm not sure if there's a need to go over that again as we went through it the last meeting, but we're happy to do so if we need to.
I just had a question there. I think the balances probably are significantly higher now than they were then. Is that right? But I think it's scheduled to make that decision at the end of the year.
You can make a
rebate
decision
amount.
whenever you
Yeah.
like to, and then we can schedule it for the end of the year. It's usually when we do reallocations.
Yeah, I knew
So,
that was sort of,
yeah.
that's what my expectation was, I guess, is that we make it at the end of the year.
I don't know if you need the commissioners to approve that reallocation, so I think we move forward on that, but what you really, did we come down to, and I can't remember, did we come down to an actual amount we were going to reallocate? I know Ralph, that's come up a couple times on our budget.
I think we haven't.
No, we have not. I did want to see if we could talk about it today, at least a little bit, when we get down to that item on
Well, let's just wait till it's on.
4D. 4E. We have that item to discuss.
We'll wait.
Tyler,
Yeah.
I noticed that on the most recent agenda that you sent, that I received, I think today, you had some other items under fiduciary governance. They weren't on the agenda that
Yeah.
I received on Friday.
I just noticed that as well. The one that we sent you on Friday was the updated one. And my apologies. As I got this here today and looked through it, I realized what's in our packet doesn't correspond with this, and this is the updated agenda. So this has a few items that were left over from our last from our last meeting, so my apologies there.
I wasn't sure if you needed this.
I would blame Lindsay, but she's in North Carolina. And it's my fault, so.
Okay.
With that being said, so under that, under the agenda, Ralph, that proposed Erisa budget is 3B. Do we want to take the time and just have that discussion now before we move into kind of the investment outlook and economic update?
I don't know, what do you think, Kelly?
Or do you want to reserve that
I
to?
think we should circle back to it when we talk at each.
Yeah, I agree.
Because then we-
I agree.
we
Let's,
can
Okay.
I think we should hold off on that.
Okay,
reallocation, we can also talk about, future.
okay. Okay, perfect. Well, with that, we'll move to the investment review. Grateful to have Bill Wallace, who's our Chief Investment Officer, with me today to go through that. Probably timing's pretty good. It seems that in the last few weeks, the market either goes up by about 500 points or it drops by 500 points. So Bill is here to explain exactly why everything happens the way it does, as well as to tell you exactly where it's going. But what I thought we'll do is we'll jump in and have Bill take some time around the economic outlook, give you an idea of some of the things that we're looking at in terms of the state of the economy, and some of those things, then of course go through the reports for the investment menus for the plans and discuss some of the managers that we have in place there.
Thank you, Tyler. So first off, if you'll go to page 28 in your Soltis packet, there's several pages here. I won't go through in detail, but it's information for you. As you may know, the markets have actually had a pretty good year, and it's really a recovery from a really strong downturn in the fourth quarter of 2018. But as an example, the S&P 500 is up in the neighborhood of 18%, which again is retracking some ground there because the market was down about 15% in the fourth quarter. But nonetheless, the U.S. markets have done very well year to date. International markets are also up, but not as in strong of fashion. One of the things that's been interesting to note, if you're looking on page 28, and there's a graph there in the upper right-hand corner, which shows the federal funds rate over a long time period, and out to the far right, you see two dotted lines. One is the blue line is the Fed's forecast for where they think rates will be, kind of looking prospectively, and the brownish colored line is what the futures market thinks is going to happen. So the futures market thinks rates are going to go down, and the Fed thinks rates are going to be relatively flat. There's been an about face here. If you followed Fed policy at all, they were in a mode of raising interest rates for the last couple of years and came into this year with, that's going to be more of the same. We're going to keep raising rates. They've totally changed that, and as you may know, they actually did a lowering of rates within the last couple of weeks. And that appears to be more to come there, that there's a good chance they'll lower again the federal fund rate before the end of the year. Why is that happening? There's a real interesting argument that the economy is doing just fine and they don't need to be lowering rates. The other side that thinks they should be lowering rates or tend to focus on trade policy. The current administration's trade policy is pretty negative for the world economy, and the economy outside of the U.S. is definitely slowing. We're seeing more signs of that. Britain came out with actually a negative quarter of gross domestic product growth. I noted today that there's some that think Germany may report a negative quarter. Just so you know, it takes at least 2 quarters to have to qualify as a recession, so we're a ways away from that. So the Fed's kind of looking at those issues as well. So we probably will see, more than likely, the odds are we'll see them cut again before the end of the year, whether we think they should or not. If you look at page 29, there's a list of different key economic indicators. Maybe a quick thing as we maybe turn our focus back to the U.S. Gross domestic product in the U.S. continues to be positive. We think the odds of a recession in U.S., as we talked about, at least 2 negative quarters of GDP, is still low. The U.S. is holding up in many ways better than the world economy. One of those reasons, job growth continues to be positive. We're seeing really robust job growth. And as you may have heard in the press, we're at 50-year lows for the unemployment rate. If you look at the market valuations, we look at the market as fully valued to maybe somewhat overvalued. We don't think there's an extreme overvaluation in the U.S. equity markets. We'd probably be more concerned about the valuation in the bond markets with rates as low as they are. That seems to be a slippery slope, if you will. And speaking about interest rates, we talked a little bit about the Fed. If you look longer term, we've gone from a 10-year Treasury note yield in excess of 3% during periods of 2018 to about 1.65% today. So we've had a huge rally in the bond market. As interest rates go down, the value of existing bonds go up. So that's been an interesting thing to watch. We have a very flat yield curve where you can't get that much more on a 30-year bond than you can on a 1-year T-bill in terms of yield. There is still a positively sloped yield curve, but that has flattened pretty dramatically. One of the things that will be interesting to watch is inflation. The Fed has a target to get around 2% inflation, and we've been hovering around that level, but a little bit below it. That's part of their argument for why they feel like they can lower rates is they're not at their inflation target that they want to be at. Looking forward, I think our feeling, we're fairly optimistic about the U.S. markets. We're a little bit more concerned about the foreign markets in terms of overall asset allocation. We actually have taken a stance. We've been overweight equity in our allocation recommendations, and we've scaled that back a little bit. We're still overweight equities versus fixed income, but we're moving more towards having what we call normal weights, a normal allocation, and not overweighting one or the other. Just because we've been in this long expansion and, feel like doing an overweight's not as warranted as it was several years ago. I'm going to stop there and see if there's any questions from the committee, any areas you want to take a deeper dive on from an economic standpoint. Okay. Let's move forward then to our plan investment review. Starts on page 34. And Tyler, feel free to jump in wherever you want to.
Yeah, the first thing I'll just mention is, so this is report run for second quarter for this meeting, so it's June 30th. So the collectives and some of the fund changes that we had in the queue happened at the end of July. So when you look at these reports, they reflect June 30th. Which those changes have been made, but that's just part of the quarterly reporting process that we have. So the collectives and the changes from the last meeting are in place. Just be aware of that, but the reports won't reflect that because they're based on the second quarter end.
Okay, thank you. You can see a summary here of these. The top plan was about 102 million in value in June of 2018. Moving forward to June of 2019, we're just under $142 million. One of the things we like to point out there is that just right below that at the bottom, the weighted expense ratio for the plan. So for the underlying expenses of each individual fund, the weighted is 0.63%, which is that's attractive level.
Well, and then with the collectives, so the change we just made,
improved,
it's
right?
actually down to 41.
Oh, great.
So that's the type of impact that we've had with those changes in the last couple of months. So 63 and 59 respectively, and now that net expense is at 41 basis points.
Thank you, Tyler.
Yep.
The second plan here, we're 22 million a year ago. and about 23 million more recently at June 30 end. You can kind of look through and see where, if you look at the percentage columns on both of the pages, you can kind of see where plan assets are emphasized. There is a pretty large amount in the government money market in both plans, which is probably an education issue perhaps, Tyler?
Yeah, well, and I think as the committee knows, as we've been on site and doing meetings, I know actually just last week, as we were here, I know we had about a dozen of those employees that were in here. We had about 9 or 10 of those that were in the, kind of in this government fund, and I think they were under the impression they couldn't move out of it. So I think that education is helping.
You're talking about the guaranteed income fund?
Yes.
The guaranteed income fund is something they can move in and out of on the pay plans. There's certain limitations on some of the limited part-time employees, right, Mark?
Yes, the time limit.
So there are some that
That
cannot.
cannot.
be guaranteed income fund in the forfeiture
Okay.
settlement.
Can you help us understand the parameters for those employees, which ones can or can't? As we meet, that's been, I think, we had quite a few just this last week that
Right.
had that
I think
issue.
it's a limited term, right, Mark? So there's,
Well, yeah, it should be a limited term. Some of them tend to be hang around longer,
but as long as you're still in that plan, under that
yeah,
particular, code, then they have to be in that account.
yeah, they can't
Okay.
do many of them.
And I guess what we'll probably wanna do is get Tucker with the names of those people.
Yeah.
I'll have Carol do that.
Okay, if you would, that'd be helpful for our team, because as we meet, that's been a question, I guess.
If you just ask the employee if they're time limited or if they're on full-time,
Okay.
then
Is there, and forgive me, and well, maybe Kelly and I can visit, we can take that offline just around those. But yeah, that's certainly kind of a question that we are hearing and trying to help address, and I think you'll see some movement on those, because some of those employees can. And I think what's happened is there's kind of this perception of, oh, you're in there, you can't do anything, and some employees can and some can't, so.
And Mark, correct me are those, are they vested in the guaranteed and they stay there? Or once they move into a different full-time permanent position, is everything open to move?
I don't know the answer to that.
Okay, so that's another question that we probably should clarify, because if
Yeah.
those dollars are in a separate
Yep,
source,
if they're eligible or not.
okay, so I'll put something together for you.
And we can talk maybe a little later around education, if there's around that. I mean, we're happy to come if specify a day, whether it's meet with the time limited employees, or again, if there's a list of those that are not time limited that can move, and we're happy to come, whether it be individually or collectively as a group, and make sure they understand that they do have other options. We're happy to do that.
Thank you. Now, let's go to page 37, and we'll get into the investment review. This report, some of the key columns, those two in green, right in the middle of the report, are a good summary. The quantitative status and the qualitative status. Quantitative really revolves all around performance versus benchmarks and peer groups. Qualitative tends to be more issues around manager tenure, risk-taking, other kind of things along those lines. So you'll note as you go down the column, the green check marks mean that they pass all of our tests. So the plan lineup looks very strong right now, with virtually every fund getting green check marks, either in quantitative or qualitative or both. We do have two plans that are on watch, and
Well, and those were ones that were changed.
those have already been changed.
Yep, so
Okay.
essentially, right now, you have every investment in your plan that's meeting your IPS criteria, both on the quantitative and the qualitative side.
What I would say then is just maybe as if you go forward to page 39, this is something we won't, since the decision's been made, but this is an example of a comparison of the bond fund, the Metropolitan West Bond Fund versus the Janus Bond Fund that was changed. This, of course, will provide all of the logic for that change. And then if you go to page 41, there's the same kind of analysis that was done on the small cap value fund, where we moved from JP Morgan to the Janus Henderson small cap. Tyler, I mean, with that, is there anything you would add?
Yeah, I would, I think just given the fact that we don't, that the managers are meeting, I'd point to maybe two things. So one is, it's part of what we're trying to do is make sure that you've got a good quality lineup in across your plans. And of course, you've got passive options as well as actively managed. For those that are active, we have a high bar that we expect them to meet. There's quantitative and qualitative components that we have written in the IPS that we're measuring these managers to. A summary that's on page 36, but I'll just summarize it. For the quantitative, it's pretty easy. We expect them to be in there, for those active managers, we expect them to be in the top third of their peer group and or beating their passive benchmark. So that's a pretty high bar that we expect to see on the quantitative side. And then on the qualitative, there's all these other elements that we look at too, that we think are very, very important. The qualitative, I think, helps us measure or gauge how likely we think it is that manager or managers can repeat their excess performance. And so that's measured on the report 37 and 38. And if you look at 38 real quick on the quantitative, this is one of the metrics that we look at right now across your plan based on the assets and how they're put across there. The active managers, your plan on average is outperforming their passive index by about 0.81%. Now, what I would say is with the 20 basis point reduction that we just got from the collectives, you're pretty much close to about 1% of excess return. And then we measure those managers, how frequently they're beating their benchmarks. And right now that's at about 79% of the time, just under 79%. So those are important metrics for us to look at as your consultant, to look and say, okay, are the managers in this plan, are they performing at a high level? Are they adding value above and beyond their passive benchmarks, and are they performing versus their peer groups? And so I will be the first to say it's not all the time that we have the whole menu that's meeting those guidelines, but right now that is the case, and I think we think that translates into good, strong investment options for your plan participants.
I got one question there.
Yeah.
Does this analysis include a review of how well they perform in the down market? So if we have a significant correction, are they expected to outperform the market itself?
Yes. So really good. So good question, Dave. So if you look on this report on page 37, one of the things that you're going to see over there is what's called an up capture ratio and a down capture. And those are two really important metrics that we look at. And those metrics tell us in a down market whether or not we expect that manager to perform better than the market, or if they would historically be a little more volatile. And so that's an important metric that we look at, and it's part of our overall consideration for whether or not we have them in the plan. Thanks. The other thing that I'll just point to as well, and this kind of helps with that question, is as we don't have managers to report on, one thing I'd like to point out and maybe just take a minute on is the qualitative scorecard, and that's on page 45. So without sounding too trite, the quantitative side is pretty easy, right? Investment managers, they have to post their numbers. You see what they are. We can screen them, use tools to look at whether or not they're performing well. The qualitative is really the more, if you were to ask us which one of these is the more important part of our process, it's certainly the qualitative. And the reason for that is when we go do due diligence on a manager, it's the qualitative factors that help us determine whether or not we think that is a manager or a strategy that we can count on and be reliable to perform and continue to perform. And then what we do is, so we look at the qualitative side first, and then we actually go to the quantitative side to kind of validate our research. In other words, if a manager tells us, hey, I protect really well in the down markets, this is when I tend to do well, we listen to their strategy, we look at their personnel, we look at all these qualitative factors, and then we go and look at the quantitative factors to really validate if what they're saying reconciles with the way that they run their strategy. And that's an important element for us because that really is one of the key drivers of what helps us understand and identify a manager that we think can consistently outperform. And so this scorecard on page 45, it just shows you some of the things that we look at. So manager tenure, I'm starting right there on, if you look at the column headings, third one over. So manager tenure, so one of the things that we like to see is we like to see a manager that's been on the strategy, that has experience. We're not too interested in having our clients letting a portfolio manager cut his teeth or cut her teeth with our clients' money. So we like to see management teams that have been in place, that have tenure and experience, and they've been through good and bad markets. The Sharpe Ratio is an important metric, Dave. That also speaks to how much risk they take. So one of the things that we look at is, okay, they may perform well, but if they're performing a little bit better, but they're taking twice the risk of their peer group, we're not sure that's the type of risk reward ratio that we're looking for. So Sharpe Ratio helps us measure that, how much risk that portfolio has, and that risk is measured by volatility. Fund size, certainly in certain asset classes, you can see down there in small cap and mid cap, really good managers tend to attract a lot of assets, and in those particular asset classes, if they get too big or they don't limit how much money they can take in and manage, it definitely limits their ability to repeat and continue to perform at a high level. So we watch very closely there. Net expense ratio, I think most of you are aware in the investment policy statement, we state that our preference is to use managers that have below their peer group, below the average category expense ratio. So we look and watch closely there. Style consistency. Style consistency is if we have a manager that is a value manager and we want to make sure that they are following that discipline, and all of a sudden they don't become a growth manager simply because they feel like they want to go buy some growth stocks. And so we look at how consistent they are there. And then we also look very closely at their firm, their status, whether or not they've, some firms, they get bought out and the owners and reorganization happens. So those are all important things. So this scorecard gives you a little bit idea of a number of the qualitative things that we are diving into and researching with each of the managers in your plan. And again, just want to take a minute there because typically we have managers to talk about and report on, and so we don't get to spend as much time on that report. But this is really, I would say it's really the qualitative side is what helps us identify managers. The quantitative side is what helps us to validate how good they are. Any questions, or I'd turn to Bill and ask if he's got any additional comments.
I don't.
On that, you have a yellow mark there.
Triangle.
On the Prudential Series Fund Government money is with the Sharpe Ratio. Is there something going on with that?
Well, that's the guaranteed income fund.
Yeah.
Yeah, that's what I'm asking.
That's a direct product, and there wouldn't be any of that. It's just,
Does that mean-
remember, we state the interest rate twice a year.
Yeah.
For 6 months going
So the Sharpe Ratio doesn't really apply. is what you're
Correct.
saying. Okay.
Correct. Yeah, under those, the one thing you can't factor in is the guaranteed part of it. So we look at them, that way that ratio is done, it looks at the portfolio and it's.
So a not applicable would be okay.
Yeah, yeah.
Yes.
Yeah. Kelly can go back and tell her guaranteed income fund that their Sharpe Ratio needs to look a little better.
Some of the others, though, it would be applicable, but there's still a triangle,
Yeah,
like the small cap value.
yep. So what that means is if we're looking there, Kim, is that if they have a yellow triangle, that means that they are either nearing kind of the threshold that we want to watch them very closely. So for example, when you look at your small cap, and this is pretty common, in small cap space, what happens is managers do really well. They hit a 3-year screen, and a lot of institutions, once they got a 3-year, then all of a sudden this flood of money comes in. And so a small cap manager that will say, hey, $1 billion is really how big my portfolio can be. If I get bigger than that, I can't buy some of the stocks that I'd like to. And some asset managers will say, well, we're happy to take your money. So $1 billion is where we should be, but if we end up with 2 billion to manage, I guess we just do it. And so that's something that we watch closely, and in certain asset classes, mid-cap and small-cap and emerging markets are definitely areas where you have to kind of watch that and be careful about it.
Another thing to be aware of is here, it takes several. They need to be getting that,
Yeah.
you know, when they get up to 3 of these 7 that we're looking at, that's when they would go on qualitative watch. So you could have one of these go wrong, and that, in our minds, not enough to put them on watch. So, you know, as you look across, most of them might have one triangle cut that looks like the Barron Partners, for example, has 2, but we would not put them on watch until there's 3, with one exception. If the manager tenure changes, that's an automatic watch. For example, if there's a turnover in manager, if the new manager who's put on the fund, you know, doesn't have at least 5-year tenure, they would go on watch. Oftentimes what happens is there's kind of a senior manager in a fund and a junior manager, and sometimes when the senior manager decides to retire, the other manager's been groomed for a number of years. We would consider them as part of the plan, but kind of have them on, you know, can they continue to carry forward what this other manager has done? But that would be one caveat to, that's the fastest way for a fund to go on qualitative watch, is if there's a turnover in manager.
And that fund size, is that referring that they're larger than you think they should be? Is that why there's so many in that column?
Or that they're near their capacity.
How do you determine capacity?
So we have metrics that we kind of look at. For example, like on the small cap side, we typically tell you a small cap manager, if they start pushing 1.5 billion in assets, they're going to have to start buying mid-cap companies, because at that point their fund is so large that they can't go and take positions in a small company. They'd either have to take all the shares down, or a large majority of them that would violate their own parameters. And so we have kind of metrics in place. Mid-cap, it's around that $10 billion range, to where they start pushing those numbers. That was where we'd kind of put a triangle and say, hey, they're either nearing that or they're a little bit beyond that capacity.
One thing that's not uncommon in the industry is a manager will recognize the need, and they will actually close these funds where, you know, it's an open-end fund, anybody can get in whenever they want. Well, they do have the ability to close the fund, and we would watch that and consider that as a positive, in one sense, at least, in that they're looking out for the best interests of people who've already invested, because they recognize themselves that there's only so many good investments or good ideas that fit their strategy in a smaller company universe. And so we would, in one way, we'd applaud that. In another way, we'd be like, oh, darn, now, you know, we can't, you know, typically what the closes will be, if you're existing in the fund, you can continue to invest, but it's closed to new investors. And that would always be the case with 401ks. Sometimes they do what they call a hard close, and so even if you're, you know, already in the fund, you cannot put more money. But again, that's outside of the environment of a 401k.
Any other questions? Okay, I know we got in the weeds there a little bit. I think it's,
No,
but
that was interesting.
but there's an intention there I think we want to make sure that from a committee standpoint that we demonstrate these are the different things. I mean, as we get on phone calls and actually get on airplanes and visit managers, these are the type of things that we're looking very closely at, and having discussions around. Again, it helps us ascertain their ability to repeat. So it's not enough just to put up a good number and say, hey, that number's pretty good, but to look at them and say, can you repeat that number? And these qualitative metrics really help us drill into that and their ability, and that's part of our process to make sure that we can have managers that are performing and providing excess return. Okay, if there's no other questions on the investment menu, I think we're at the Prudential Plan report, and we're happy to turn the time over to Kelly and go through that big thick book.
Well, we'll be here till 10. That's better. So why don't we go ahead and start on page, under section 1, Page 4. So as you can see, our combined page has changed a little bit. It's changed as we no longer have assets in Plan ID 111416, which was a 401A plan. There was approximately $33 million transferred into the 401K plan on or about June 18th this year. So what that has left us with is 458 active participants with balances in both 414 and 415. Do we have any questions on that transfer or?
I'm just, curious for those on, the committee who had money in the 401A, did you see, did it look okay to you? Did you see any problems? Have you looked at it?
Well done.
Yeah, I did.
Thanks.
Okay.
Thank you. Straightforward.
Good. Yeah, and I think it really has helped a lot of the participants as well, the employees, to just not have so many plans. And it does, I guess the one downside was that we did take a loan away, but we don't necessarily want them to have a lot of loans anyways. So, as we get through the grandfathered loans, then the 401K will just have one loan parameter on it. And so that's a good thing. So we were able to accomplish that. We had good employee meetings around that with both attendance with myself and Prudential, as well as Tucker and Kelly also helped us from Soltis. If you want to turn, we have a new page, and we'll save the expense account stuff for later, which is the next tab. And we'll go ahead and turn to page 21. It's a new historical plan statistic. I don't know why this thing is making so much noise. What we have is we have a 4-year, year-over-year with a lot of different statistics in it. This has been very helpful with a lot of our plans who, we go over these things and we bring it in by quarter and we never remember, what happened from year to year. So we'll just spend a little bit of time on this page. So it really takes us from 1/1 of 2015 through the end of last year. We look at participant balances. As you can see, they've grown. We've looked at contributions to the plan, and they've stayed around, for the first 3 years, around 62, 63, or 6.2 or 6.3 million. We jumped to 6.8 million for the end of 2018. Not exactly sure why the jump went up, but that's a great number. How much distributions we had out of the plan, again, very solid and very steady. And then it's always good to see that we have a positive cash flow. There's quite a few plans that I have that I can't say that every single year we have a positive cash flow. So that all works well for your participants and helps us, take a look from a pricing standpoint. What that is all things that is taken into consideration. And that went into some of the pricing last year when we went through that exercise. We also look at average account balances. You can see we've got year over year, they've grown. Dipped a little bit in 2018. Again, that could be from some people retiring. You do have more people retiring every year as we all get older. Participation, we have our participation rates always sitting around 80%. We have in the past tried to target those people that have decided to go, out of the plan. Certainly something we can talk about again, to just continually talk to them about making sure that they're staying in the plan. Asset allocation, we've got percentage of assets in the stable value plan. So that has gone down from 26.1 when at 2015 down to just over 20%, which is good. It's definitely lower than our Prudential average. We've got a nice participation in Goalmaker. It's considerably grown from 30% up to 52%. And we've got over 669 people participating in Goalmaker. To refresh your memory, that's the asset allocation tool that we use. Uses all the funds that Soltis provides, and then it gets asset allocated by conservative, moderate, aggressive, and then your age sleeve from retirement. So, has been very successful, and obviously your participants like it because they continue to use it. We've got some people using one fund as their total total allocation. We have 114 of those people. It's gone down steadily. Again, we have done some, communications in the past, and I'm sure if you look at the years, 17 and 18, since you guys went with the previous advisor as well as Soltis, coming in once a month and working on with participants, I think that helped drives that number down as well. Number of distributions, as you can see, is pretty steady, except for that one year in 2016. And then again, loans as well. We're at just about 20% of loans taken out in the plan, but it's pretty steady, anywhere from around between 70 and 80 in there is what we generally have. We currently have 250 outstanding loans, and there is something that we can talk about as we talk about in-plan Roth conversions and after-tax, which would mean we'd have to add an after-tax source to the plan. We do also, in conjunction with being able to do Roth conversions and after-tax, we would be able to talk about maybe an emergency savings account. I know we briefly touched on it before, but that could be something that could help us drive the loans the other direction. We won't spend a lot of time on the second page, page 22. It's what we kind of look at. This one's quarter over quarter, but we did, as Tyler mentioned, finish at 141,571,269. If you look at page, we went over a lot of these plan features in the historical plan on page 23, so we'll go ahead and move on. Page 24 and 25 is those benchmarking trends that I had talked to you about. That you can take a look at your leisure. Let's move on to page 28.
Was there, was there, the option for an employee to enroll in the accelerator, in the contribution accelerator? Did we talk about that? I'm trying to remember.
So, those of you who've been on the plan since 2016 or 17, we, tried.
But I thought
And
we
at
were
the
gonna make it
last
optional.
minute-
I thought we were gonna make it optional, so that it wasn't a, or is
I
that-
don't know
or
if
is
we
that
ever
un-
got that through the commission.
Okay,
That'll be something that
That's
you would
where it
need to
stalls.
put on the commissioners.
However, we have different commissioners now, and the one that was totally against it is now gone.
I think we should go again.
Okay,
think we
I
should
don't mind.
I think we should give it another go.
I would, if we're gonna do that, I would recommend that either myself or Tyler and his group come in and talk about contribution escalation to the commissioners.
Yeah.
So it's not like telephone, right? Do you know what I mean? Cause I think that's kind of what happened, was it was talked about, but it wasn't really talked about with, you and I who would be making the recommendation. So I would think it would make sense that one of us would be here to address the commission and why, and bring some statistics in. Talk about, like I just put it in a plan. And because they have a really good participation rate because they have a safe harbor, but it never goes anywhere. Like it literally stays the same forever and ever and ever. And how are you really helping, if people from a nurse's standpoint don't do anything, how are you going to help them do anything? So we can bring in lots of stats for them, just for them to understand.
What kind of, timeframe on that?
Well, a lot of people like to do these at the beginning of the year, right?
Maybe
So we've got
towards-
some time.
In the fourth quarter, we could.
Well,
do
we
that.
probably want to do it sooner rather than later to the commission,
Gotcha.
so that we can get it teed up, because end of the year, all the changes, we've got to get it teed up to get you in line to do it.
We would support, I think, in terms of auto enroll and auto escalation, which is what this is. Those are two really powerful tools that help people get to really a level of contribution that they're really going to need to have a significant amount of assets that can really they can count on. And it's just like auto enroll. You see very inertias. It goes against you and you can use it to your benefit. You see very few that opt out, but they have the ability. So at any point, if they say, I don't want my stuff to increase, I don't have to. Most of them are, you do them at an annual level. So it's, hey, yeah, I got a little bit of a pay raise. And my
When you already
contribution
have
is
auto enrollment, so you're halfway there.
Yeah.
And there are some vendors that require you to do both at the same time. They won't let you do just one or the other.
Yeah.
Because in a private sector world, you have testing. And it really wreaks havoc on testing if you put in automatic enrollment and you don't do any kind of contribution escalation, because then all of a sudden you're getting a gap, right? Because everybody's enrolling at and never going up.
Right.
So if you look at the next page, on page 29, you'll see that almost, this is a big good statistic for the commissioners, almost 60% of your participants are at the match, right?
It's not a
And
surprise.
I can probably go back and pull all the books from 2015, and that number probably is sitting right about the same. So you have not had much movement at all
And-
in your
and
plan.
One of the things I'd be interested to see is how many of these other government plans that have the accelerator also have a pension plan, a defined pension plan, because I'm guessing that a lot of employees are relying heavily on that pension plan and only want to do the minimum in.
Yeah, the only problem is, most of those have social security also, which we
They do.
don't have, so that's the opposite.
I know, and that's what worries me too. You go back and look at the statistic on the balances of ours compared to the national average, or the other averages that you're showing, and our balances are below that. The only thing I can think of is it's based on a percentage of salaries, and our salaries may be lower than other areas, but if anything, I would think our balances should be higher because we are replacing Social Security. But the only thing I can think of is that they're relying heavily on that pension and only wanting to do the minimum in.
Well, and most states and counties have pensions. I mean,
Yeah.
most municipalities, I would say the majority of them all have pensions. Now, whether or not they do Social Security offset, I don't know if Prudential would have that information. Possibly, though, one of you that are going to NAGDA, you need to nail down one of those NAGDA people. I guarantee you someone in NAGDA is gonna have that information. Because that's their association, right? They're gonna have that information. So that's what I would do, is try to find out from a NAGDA perspective, how many people are doing contribution. And we can certainly do it on our book of business. That's not tough at all. To find out, just segregate the government plans and see what we have, and we can bring those statistics to bear as well. So, is that what I'm hearing from
Yes.
from you guys, that you're looking at opt-in again?
Mhm.
Or, excuse me, opt-out again, where we're putting them in and they have to go and opt out if they don't wanna be part of it?
Right.
Is that what I'm hearing?
Yeah.
Okay.
You have
Can-
any feedback or pushback from employees on that, or
No.
you just
A
think it's
couple,
good
we had a
idea?
couple.
There were a couple.
There were a
Very
couple.
few in number, I think, but very vocal.
Yeah, I haven't heard it myself. You guys probably did before I was here.
Yeah, there were a couple, and unfortunately, there was some misinformation about the Social Security offset. Each person is different when it comes to what their Social Security will look like, because there is some parameters in years where they can take into consideration the spouses as well. And so that particular person, from my understanding, did have, like, if she contributed too much to the 401k, her husband's could have been offset as well. But that's few and far between, and and that's where the education comes in to that individual. So
You're
my,
talking about the windfall provision, right? Is that what you're
well, it's a
talking
federal provision, and from when I researched it back when we were going through all of this, Clinton signed into law back in, I don't know, back in the 90s, where you hit a certain threshold, and then they can go in, do an offset to the spouse.
Right.
It doesn't necessarily affect a lot of people, but in this case, she went to her accountant, and I think it did. So again, telephone played where they all talked to each other, and then one of the departments kind of got in an uproar because they were like, and my thought would be then
All we had to do was
that opt out,
Yeah.
exactly. That's all they had to do was opt out. And so that could be something, as we educate, we could say, if you're uncomfortable with this, then here are the parameters. You can opt out at any time, before it's done or after it's done or whenever. So we just have to be better about communicating their ability to opt out if they're worried about any kind of Social Security offset. We'll speak to it. So I think that
Can
would be
we
better.
make a recommendation to the commission at this point, since it's not on the agenda, or do we have to wait till the next meeting?
I don't know the answer.
I think we would need to wait.
Till the next meeting, which is in November. Is that enough time to still do it by the first of the year, or no?
I'd have to know before that.
We could call a special meeting, though.
All special
We can
meeting?
do it telephonically. So that's simple to do. But I don't think we need to actually approve that before there's a meeting
No.
with commissioners, though.
I
You just
agree.
Inform them as to what we're thinking of and why, and
Get a feel from them and then,
then we can
Have a
call a
special
special meeting.
I think there's only one commissioner left that was in that vote. I think only Lee is the only one. I think the other two, because Ivy wouldn't have been, he would have just been getting elected,
We just,
right? So I think we only have one that's even gonna remember. So I'd be certainly happy to talk to any of them on the phone from a historical perspective
maybe
of what
we can-
happened.
I will. I'll set up the meeting with the commissioners, and I'll also set up the ad hoc meeting, so that we can get.
Okay, got it.
And, can you add that to our, bi-weekly call as well?
Yep. Okay. So if we want to look at page 29, we can just see, we won't spend a lot of time on it, but we can just see that here's where your contributions are sitting. It shows we've got 7.7 people at zero, as of that quarter, as of June 30. And then you've got quite a few that are underneath the match, so you're looking at 10, 13, 19, you've got 25% of your population not saving to the match.
Are we
So-
able to identify those people?
We can identify them.
Yeah.
We can also re-enroll them. If we do a contribution escalation, we can throw them right back in the plan if you wanted to at 6%.
Yeah, I feel like they're obviously missing out on an opportunity, so. And,
Well, in particular here, because this is their social security offset that they're getting up. Okay. Great. Let's go ahead and move to page 33. We'll just talk quickly about the auto enrollment features. During the period, which is over the quarter, we had 23 people who were auto enrolled in that period. We had 7 people that changed their option from default, meaning they either went up, went down, changed their funds, something, they did something. And then we did have 3 people who chose to stop participating during the auto enrollment process. So again, does that mean we need a little more education around, what that means for them? Possibly. Let's see, for statistics and timing, let's go ahead and move to page 41. This kind of will go into our Roth discussion. Right now, it looks like in Roth, we have just over almost $2.5 million in Roth with 203 participants. So that could be, again, that growth could be from the monthly meetings, talking to people one-on-one to talk about, does it make sense for them to do Roth? Is this the time where you think you want to talk about the Roth conversion piece?
Yeah.
Okay. So you are in a 401k plan, so unless your document states you cannot have a Roth conversion, which it probably doesn't because you have Roth. Now your plan is outside drafted, so that's something you guys are gonna have your, either Tyler, your group, or the attorneys look at, because we don't give legal advice on outside drafted documents. But from a standpoint of Prudential, we can do a conversion piece, we can add it to our system. And so it is available for you to do if you want to do a Roth conversion. Now, would you like a little background of what Roth conversion is and why we do it and why some people like it?
Yeah.
So basically, if you make over, and I don't know the exact number this year, but like $120,000 a year, you're not allowed to convert a Roth or participate in a Roth, right? So for what, 10, 12 years ago, 15 years ago, they allowed the Roth to come onto the plan. But vendors had a really difficult time instituting the conversion piece. And part of that reason is because every time you convert a portion of your money to Roth, it starts the 5-year time clock to leave it in there to get the Roth tax advantages of it. And most companies couldn't do it until a couple of years ago. We couldn't record keep, because what people do is every year they'll convert a little bit more. Like if they want to take the tax hit in 2019, 2020, they'll do it over like a certain period of time and convert it to Roth. So we now are eligible to do that, to be able to have that option. But the other thing you want to check your document for, because once you convert it to Roth, to Roth, is that after-tax piece, right? We want to just make sure that the conversion's in there, because it's considered. There could be some parameters around your document for the Roth conversion.
So Tyler, is that something you can look at and see,
Yeah.
see if we're covered there?
I think what, from our standpoint, we have to look at it, prototype document by document, for the majority of the money.
They're on a volume submitter.
So I think we can kind of go through that and find out, to make sure you have the necessary information.
And we can always, sorry,
If a person wants to put $5,000 from their 401k then into a Roth, they will be taxed on that $5,000, right?
At that time.
But that could be a planning tool for certain individuals.
sure. It's
Wants to do that.
yeah, sure. We're doing a lot of it in the private sector. Be-
Pretty standard.
Yeah.
Yeah.
Our plans, almost, we're a big advocate of having Roth as an option. It's more flexibility for the participant. Very rare that we don't have the Roth available, we don't have the element as well. I will say, the one thing about it, if you want it, they need to be educated, they need to make sure they're having a conversation. Because there is tax implications, and there's some things that they need to understand. Such as, hey, okay, we'll just convert it up and pay the tax that might down. Can't do that. There's some things they need to understand. Something like, hey, if I convert X amount of dollars this year, that's all income, all of a sudden I get pushed into a higher tax bracket. And now all my income for the whole year is taxed at a higher tax. So there's some things they just need to be aware of.
Because once you get it into an after-tax status, you have that higher limit, right? You can go up to the limit, the after-tax limit, $54,000, somewhere $55,000 a year, that you can put away if you have an after-tax source as well. So, Roth conversion and after-tax is big buzzwords right now around that. And so probably the most sense would be to add the Roth conversion first, seeing you already have the Roth, and then go from there.
Well, I think that's something we should
Yeah,
consider.
I agree.
I don't know why, it's an option that I think we should have available in the plan.
You have Roth, so, and there's a conversion, so it doesn't make sense not to. So that would be another topic for our biweekly, just to
Yes.
keep it on the radar?
Yep.
Okay.
Are you getting requests for that?
I've only had one. But,
It'd
you
be
know,
nice to have in
Yeah.
case somebody wanted to use it.
That's an option.
This if you already have a Roth IRA, you gotta be able to use it.
Yeah, there's nothing wrong with
Spend with it.
having that option.
Right.
Yeah, I mean, it's not an option that's going to apply to one. If you have a Roth option in the income level that most people are, it's going to be Roth. But it certainly allows them to say, look, my plan is plan. We talk about this a lot with Roth. It's hard to guarantee that the benefits can be better from a tax standpoint. You just don't know when, right, the tax code every year, Congress gets together and says,
Change it.
change it or not change it, so we don't know what that would look like, but we've talked about it a lot with respect to, hey, it gives you some diversity in retirement on where you pull money from and how it's taxed, so people that have Roth assets to some extent, can look and say, well, this year I'm gonna have the kids, I'm home, so I'm gonna take the majority of my income out of my Roth, which is income level, so it just gives them the ability to control that a little bit. But, I mean, it's not a feature that you're probably gonna see, it makes sense, 30, 40, 50% of the population. Say it's more like a quarter or less, but where that quarter, is pretty efficient to help them plan for long-term retirement.
Yeah, I wonder too if those who retire, it might be an incentive for them not to roll their money out if they have that as a planning tool going forward.
Yeah, I mean, typically for somebody that's close to retirement, it doesn't make a lot of sense to do Roth conversion. There's some, I mean, again, that's a general rule of thumb, and there's some circumstances where it may. So it's usually for Roth conversion, somebody that's midway through their career, they stay pretty good in their assets, they don't really Roth assets. Hey, it probably makes sense to convert some of that over. I'm okay to pay the tax right now, I mean, I can feel, in doing that, and again, it gives you enough of a source. I mean, with Roth, I think we try and tell participants, it's very specific, so everybody's circumstance is very different, whether or not Roth can, and I say so.
If you contribute to a Roth 401k, can you also contribute to a Roth IRA at the same time?
Yeah, so you have the ability within to do contributions either, so you're contributing to 401k, you can come to a traditional IRA, or you're doing a Roth K.
You just have to stay within the limits of both of those. There's nothing that prevents you from doing both.
The only limitation is income. If you're over a certain income threshold, you can't do a Roth IRA. There's no income limit for Roth.
Is it a taxable income level or is it gross income?
It's your adjustable.
AGI.
That's the gross income.
So with that, we're pretty much through the plan demographics. Do we want to move on to some of the questions around the expense allowances and the Erisa budget and reallocation?
Yes.
Okay. So if you want to go back to tab 2, we can look at the expense account. And so if you want to pull your microscope out, your little, I had to get my phone out to actually read these numbers. We can just talk a little bit about, where we're at, and does anybody have any questions on any of the expense account information that Carol puts together for us? And I know she sends it out earlier, so you guys would have gotten it by email earlier.
Yeah, I wanted to know about of course, we had the deposits made back into the expense account and the forfeiture account. And since those have, pushed us over significantly over the recommended balance, what I believe to be the recommended balance, I wanted to know what is the best way to reallocate that and what will help, the participants the most, is really what I'm curious about.
So what normally happens on a reallocation is that you can do it whenever you want to do it. I have plans to do it mid-year. I mean, if you'd like to do it sooner rather than later because the amount's so large, we certainly could do it for a fourth quarter 10-1 if you wanted. Most of the time, what people do is just do pro rata, right? For those people who are participating on the date of reallocation, pro rata. So they get whatever from a pro rata standpoint. And that's easiest for us to put together, help you put together a spreadsheet, and then we just take that money and whatever amount you decide that you want it to be, and then just divvy it out pro rata. Then what would happen would be, so let's say you wanted to do it immediately, let's just assume. So if we did it in this quarter, that would show up as a line item on their statement saying you have a miscellaneous credit of X amount of dollars that have gone into have been, deposited into your asset allocation. So that's how it works.
Is that what we've done in the past?
Yes.
Okay. Anyone have any questions about that?
I don't see why we need to wait, I guess, we gotta do it, get it back to the employees.
Yep, like I said, most people do it year end, but that's because it's on like a calendar, but we have some different circumstances here. Plus now they're starting to see, they'll continue to start to see the per account charges on their statements, so the timing might be good for them to give them a little kick. So you just have to direct us, and then, we might want to work with Soltis on what you think you should leave there.
Right.
Because remember, that whole crediting is stopping, right?
Right.
Once we went to fee levelization. So now everything gets put in arrears because we're collecting per account charges. So we're not gonna see our first, so we had one go in January, I had this all worked out in my head. So we'll start, their first one they're gonna see is 10-1, And then they won't see their next one till April one with the expense account, because we couldn't change that until July one, right? So we won't charge until, so it won't show up on the statement till 1/1 of 2020 is when they'll see both charges. Charges for the Erisa balance and charges for record keeping. So,
You know, Soltis, would you be able to, put together a recommendation on that
Yeah.
for us?
Well, yeah, my comment would be, I think, yeah, based on some change in the two regulations, I think we could and look at kind of projected that shift. See how that grows,
which I sent you,
yeah, and then we can go through it with you.
Okay,
Yeah.
because currently we're doing, the 24 to, and it comes out to be about 6 basis points apiece.
would this be a resolution, Dave, for the commission?
I think it'd be a recommendation. we would
Recommend-
make to them. If I
Okay.
did that.
And that does include the dollars you deposited, right?
What's that?
This larger number includes that deposit you recently did for the
Yes.
reversal.
Yes, it does. Okay,
I'll add that to the bi-weekly.
yes, yes, yes.
So are we saying there's about 200,000
I show,
total on the, I'm just looking at the total activity 2015 to the present.
I show 83,000 in 414 and 575 in 415 on our notes. I'm not looking at the spreadsheet though.
I'm just trying to understand the spreadsheet if I'm reading it right. It says reallocation of expense account. It's got a negative number of 200,000.
Well, we did one a while back, and that's probably that number carrying on.
So the balance, you see the account balance on 415?
Yeah,
Well,
but then you get all these expenses and so forth, and then it comes over and shows
So
a
page
number.
13 is the total.
Okay.
Yeah, that's what I was looking at.
Yeah, so she's got a total.
So that 200,000 is roughly what we think is available to reallocate.
No, their total account balance is,
Yeah, I have over 500,000. It's, the 570, right?
yeah, the account balance is 570 and change.
So it's
That's
570.
that's the second tab in after date.
Right,
and,
but then you've got all these other projected expenses, I thought. I don't know if they're projected or actual that are coming against that account balance.
hmm.
And then you come over to the very far right.
Why don't we, Ralph, go over this
Yeah,
with
let's do
Carol?
that. Okay.
So I think we have a call this Friday.
Yeah, let's
And
do it. It is
we'll go
a
over
little
this, and then we'll
confusing.
come to make sure that you're okay with it, but we'll come to some, because Carol's the one is the keeper of the expense account.
Well, if we keep enough funds, in there for 1 year's projected budget, and that should be sufficient, right? Because it comes in quarterly in arrears, but quarterly. So I guess my suggestion is maybe we just, request we recommend commissioners that there be a reallocation refund, to the amount in excess of a 1 year budget.
That would be like, pretty comfortable. If you go 1 year, 2 quarters, or like I say, you have a quarter.
We can do a motion for that now, right?
Yeah, we do have that as an agenda item to
Yeah.
discuss, so that would be my motion.
Okay. So we have a motion, yes?
I'll second.
And, we have a motion and a second?
For,
So this
for
is,
discussion, is that as skinny as we dare go, or
I think we might, well, I guess that's what I would suggest for now, and then give it another year.
Yeah, give it a year and
We
see.
could look at it again, maybe 6 months will be sufficient,
what do you see out there? Do you normally see a year? Do you see less than that, or?
I'd say we normally see between about 50%. Don't want to keep it 50% of it a year's flow to 100%
Somewhere in there.
So, I mean, roughly, we estimated your expenses at about 192,000, roughly, because we cannot pay those. So, keeping 200,000 in it would you guys pay it for you. So, there's those expenses, anything above that.
Reallocate.
That's what you're
I mean, I don't wanna keep too much in there, because whatever we don't refund, they can't earn.
I agree.
Money
Just
on and-
sufficient, and maybe 6 months, maybe 50%, I guess 50% should be sufficient because it's coming in quarterly, but in arrears.
I would say, given the change in the fee levelization, some of the revenue share that's, for example, like the collectives, set of those are zero. So I would probably say, I would probably lean more on keeping a little bit more towards the year. Because in this next year,
Yeah, right now, we have no funds that share revenue, zero.
Right. Which is
So
what we
now it's
wanted.
just the account charges.
That's what we want.
so I'd probably say keep it at a year on that.
I
and
see.
Pay it back, and then you've got a couple hundred thousand that stay there.
And then we can get a little experience and see what we're doing.
And
Would you
best
mind-
practice is to reallocate biannually.
Okay,
So if you did one now,
we
you
could
could
look at
watch
the-
another
Yeah, we
year
should.
and then do another because we
Sure.
see most of our
Yep,
plans
yep.
do biannual.
do you wanna restate?
I'm
the
not
motion?
biannual, every
Do
2
you
years,
mind?
right? Yeah, every 2 years.
Do you,
Sure. So my motion is that we make, that we recommend to the Board of County Commissioners that there be a, what do you call it, refund and reallocation, is that?
Yep, a reallocation to participants
A reallocation to the participants account,
by pro rata.
okay, by pro rata in, for all funds, retaining only $200,000.
Or did you wanna go 100% of?
I think 200,000 would do it.
yeah, I do
I
too.
think they say that's about what the budget was for the year. So to make it a fixed number so they can work from, I'd split it to.
Rather than cite the budget.
Because you
Okay,
will
we-
start seeing some then after, at the end of 1/1, because we'll take the fee after January 1st and deposit it. So,
Let me restate my second.
Yes.
Second.
Okay, we have a motion and a second. All those in favor say aye. Aye. That's, is going to pass 5-0. Okay, great.
We have 6 now.
Aye, 6-0. Okay, where are we at on
We're
the
at-
agenda?
the forfeiture account and conversion account, do you know what you wanted to talk about with that? Because,
I was looking at all of these.
yeah, so the
At the same
forfeiture
time.
account, if there's money in there, I don't know why there would be, because you guys are 100% vested, right, immediately? Do we have some old money?
I show some small amounts of money, and this is the notes I got from Carol. It does actually show $81,000 in the 415, the forfeiture account. And I
I
think that was an
An overpayment?
overpayment that came back.
You want that to be part of the
Yes.
forfeit, you want that to be part of the allocation too?
Yes.
Just
Can
add
we-
it to your,
Can we just add that to our?
just add it to the one you just voted on.
Yes, please.
And would there be money in the conversion account too, or no?
I show 666, I don't know what that.
I think
if
you
that
should take
has
all
any
3
meaning
accounts.
To it,
That must be some
Mhm.
trickling in money from when you converted back in 12.
and
We didn't know what to do with the money, so we stuck it in a conversion account.
there's like, $5,000 in that. in those
So why don't you do
accounts.
all 3 as
Okay.
part of your,
Okay,
So just for clarification, then, those other accounts would be included in the prior motion.
correct. Which was voted for in the affirmative 5-0 with a 6-0 with a second that does not need to be restated. Are we okay, Dave? Okay. Okay, thanks for asking that question, Kelly.
we'll get it all with Carol on the call Friday and she'll get it all.
Okay, perfect.
So I'm done until the next group of,
Okay, so, I had, Brandon here to review some changes for the benefits. I'm thinking to propose to, I don't know if it's hold or strike and set another meeting just for benefits.
Did you cover this one?
Um,
An issue on that?
That was just, had there been any feedback from employees?
Yeah.
on the fee schedule, or negative, positive? Or-
So I've
I haven't
had,
heard anything
I've had some feedback, some was good, some were very concerned initially, and then once they talked to Soltis, they were, oh, that's a good deal. So,
We had a couple that we
yeah.
that
yeah,
we
I
were
think-
happy to
I
take
think
some
we
time with,
sent
and as we went through
you
it,
maybe 5 to talk to, and they were really fired up, and then they were like super okay with it.
they were all very complimentary. I
Yeah.
think by the time,
Yeah.
I think part of that just, you know, you get those
Just
that don't understand,
understand.
and when you walk them
So-
through it, they're going, oh, okay.
I think they're understanding that we have made a really good move here.
Which I think 4 out of the 5, we walked them through how the fee was lowering for them, so they were, they were pretty happy by the end.
So did you have anything on the education, this item 5, that you wanted to cover?
Not, so we did so much education. We can remind the committee that we're doing Pro Pathways in September. Is Brandon here? Do you have the dates?
I do.
They're last week of September through October. And again, that's just a free service that has 4 seminars, 90 minutes, talks about everything from soup to nuts to bolts. Soltis is also going to be on site for those as well. The Prudential advisor is coming in from Denver, so the, majority of the work will be, held with Soltis. They'll deliver the information. But it's a really nice seminar that allows them to, not only learn about, and maybe you guys can bone up on the Social Security offset and help out with that, because I'm sure he's not, up to speed on
Yeah.
that. But that would be something that would be nice to have, is somebody to be able to speak to it just a little bit as they are working through the different modules of the Prudential Pathways. Other than that, we got the benefits fair, and we'll have people on site for that. I usually attend as well. And then we have the monthly webinars that I know that Brandon's sending out that you can go on, that's with Prudential Pathways. And then just a couple other things that are in the book. I can, is anybody using the Prudential app right now on their phones?
I'm not.
Oh my gosh, you'll never log on your computer ever again. So we have flyers that we can do up for Utah County that Brandon, you can email to everybody.
Okay.
That shows you how easily it is to get and how easily it is to log on. You can do pretty much everything on there right now, except like take a loan and things like that, but you can change your investments, you can change your contribution rate. If you wanted to open up an e-enrollment, so people who have opted out can re-enroll, we can do all of those types of things. So I'll send you that, and then he can just blast that out to everybody to use that mobile app. But that is just, I never even log in anymore. I just go on my app. It has fingerprint, just like
Oh, that's
everything
great.
else. And then the last thing is that this won't come until next year, but there's something called Link by Prudential that is taking it again, working with kind of on the prefaces of Prudential Pathways. It's just another place for people to be able to do more of an online, what Soltis provides. It isn't something we're pushing, it's just going to be available on your platform sometime in 2020. And it's just another tool that people can use to make sure that if you've got questions about insurance, or you've got questions about, are you saving enough for retirement, all those different types of things, you can work with Link by Prudential. If anybody's interested in knowing, even you, Tyler, I don't know if anybody has sent you to the prudential.com website, you can go in right now, because it's open to everybody in the country through prudential.com, through what I like to call the mothership.
Yep.
Right? So you just you put in prudential.com, you click on individuals, and you'll see it there called Link. That's going to be something that's just going to be available, just like our financial wellness and student loan is coming in like 2 weeks, the student loan assistance program. So it's just extra things we are providing to be that financial wellness provider.
Great,
Okay?
that's great.
Just
Other
a
than
quick
that, I
question,
think-
maybe Ralph. The biggest question I tend to get is the Social Security issue, how much they're gonna get. I don't know if there's a chance we could ever get somebody from Social Security come in and really talk to people about it, or if there's somebody who's an expert on that, because,
Having the people come from senior benefits, which have expertise in that area, to speak to that, and also
Or somebody
I
from
often
your
tell 'em
pension?
the best thing to plan on is not anything, and then
Oh.
consider it a bonus if you get something.
Michael Copley also has a very good presentation on it, and it would be very well attended by the county if we had a specific presentation on it.
But that's just the biggest question I always get from employees is, okay, we're out of Social Security, does that mean I'm gonna get nothing? Does that mean I'm gonna get, does that mean I don't get anything from my spouses either, or, you know, where do I
It's
stand?
probably the most commonly asked that we get too,
Yeah.
when we're here with your employees.
Okay, yeah.
Sounds like we need to set that up, Brandon. And I know we were going to set something up anyway, so let's just add that to it and make sure we get that out to the employees.
And Brandon, we have some good resources there. We're happy to kind of coordinate and help potentially there if we can.
Let's do it.
So seeing I'm on this topic, Dave had a couple more questions he had emailed to me, and I want to just address those real quickly, seeing, you know, just get them out of the way and move on. I know you've got other things you need to do. So you had mentioned about a post-retirement options and accounts for retirees. Certainly, you can do anything you want to do once you're a participant in the plan. You can leave your money forever if you want to. You can annuitize your money, you can go into income flex. You have so many options inside the plan once you retire. You can work with our distribution specialists to look at different types of annuities, but you have income flex. So, you know, the other thing is if you know you're getting groups of people starting to retire or getting really close to retiring, like in a year, we can start doing some meetings on income flex, right? To look at, you don't need to move the money out of the plan. If you want to create an income stream, let's talk to you about how you can do that in the plan, create an in-plan income stream. So that's something we can work on together with Brandon and you, Ralph, that we can just, you know, and then certainly of Soltis as well, to say, here are your options, in the plan, portfolio outside the plan, however you'd like to do it, but the in-plan options are all there for you. I think the other one that you had was,
Just on that one, my concern there, when you look at the numbers of how many have rolled out of the plan, I assume most of that is a retirement when they roll their money out. And obviously, we're all better off if that money stays in the plan.
yep.
And so I'm just wondering if there's more that we can do to show that the best option in fact is to stay in the plan.
I think those meetings for retirees is really what you would want, and, you know, certainly we can get some education for the income flex, so it's an
Yeah.
option.
So I mean, I know we've had a number of your employees attend. We do a retirement readiness session 3 times a year to talk specifically to people that are within 10 years or less of retirement, kind of, hey, as you get ready for retirement, what are your options? And that's part of what we'll go through with them. I'll say we'll sit down with participants and when we have that conversation, it's helping them understand what their options are, because most of them really don't know of, hey, I can't leave it in the plan, or I need to move it over here, or how do I turn it into a paycheck, et cetera. And so typically when we sit down with those participants, we'll actually help them go through planning way back from the early days of when we did our proposal. That's part of what we do, is we'll sit down and actually help build a financial plan. We're fiduciary to the plan, so that financial plan we help build, you know, won't have conflict of interest in terms of, hey, let's get your money out of the plan and over here into a product. So we can take them through that financial plan, help them look at what the assets are, what type of income stream, and then lay out for them, here's the options that you have in terms of what you can do. And I think a big part of that is that they don't understand they can stay in the plan, what options are there, and what might make the most sense. So.
And the follow-up question is there anything that we ought to change or offer that we don't currently that would make it more attractive? to
In the
someone who's
plan?
retired?
You guys' plan has about as comprehensive of options as most of our plans. A lot of the income flex has been slow, whether it's Prudential or any other. It's a good product, but when you say annuities have a little bit of a bad rap, and to some extent for good reason. But
And it's not
but
an
the
annuity.
products, but the products in
It
there.
looks like an annuity.
And we'll be the first to say where we have plans that want, and we think Prudential's is, when we have a plan that wants a guaranteed income option, we think Prudential's is as good as there is out there. So I think your plan actually has more than what most plans do, because a lot of plans still don't offer a guaranteed income option.
Good. That was kind of
Yeah, and historically, the income flex hasn't been real popular because you've got the pension, right? So there's their income stream.
Yeah.
And a lot of people look at their 401k then for the other stuff, the renting, the buying the cars, replacing cars and refrigerators and things like that. So, but again, for those people who don't get their Social Security, that's where the income flex will come in,
Yep.
where they can create a Social Security, right? We can create that for them. So, my thought would be, if it is something that you want a little more, you've got 6 meetings a year. You could have a couple of meetings for you people you have told you they're gonna retire, and you can send them to the meetings, the educational meetings, because we've got 6 built in now, and we'll only be using 3 days this year. So if you wanted another retirement-ready one by the end of the year, we would have, we have room to do that.
That's a great idea. I think we should add that to
Okay,
our
I'll
our
put it on the
bi-weekly
list.
call.
Okay.
Okay.
And then the last one, and I think, Dave, we talked about it, was the spousal accounts. Because this is a retirement plan, and you have to be in a retirement plan to have an account within Prudential, we can't really mirror somebody that's not in one of our plans. It just doesn't work that way. However, I did do a little research on our financial wellness tool that we have available to you. And within that budgeting tool, so you can use the budgeting tool, it has that aggregation tool like mint.com, and what are some of them other aggregation tools that pull up all of your information. If you and your wife like share all the accounts and you know all the passwords for both accounts, you can load them up into your financial wellness tool. So if your wife has a Fidelity account and you know the username and password, and you can load it right up in there. So there is an option to start tracking all the different accounts through the budgeting tool. So it's best we can do.
All right, so I need some feedback on whether to review the benefits changes or whether to set another meeting for that. And I'm fine either way. It'll take,
I'm fine doing it now.
15 minutes probably to go through it. Okay. Okay, Brandon, you're up. We've been working with Gallagher, our benefits broker, to come up with some plan enhancements without increasing cost. Change some of the plan design and some of the vendors, which will in most cases save money, except for one instance there is a slight increase in cost, but no increase in cost to employees. So Brandon will go through that.
Okay, we'll just kind of go through a quick high-level overview of this. We'll zip through the first few pages, good information. If there's any questions, certainly come find me, talk to me, and I can go into a little bit more detail if you need. But we're going to go to page probably 4. We're talking about the medical plan, no changes. We're sticking with our select health share. Just the only information to provide on this, we met our metrics by July of this year, about 70%. So our renewal rates for this upcoming year will be at 1.5%.
Is that right?
And then we will have the 3-year renewal option, which should be favorable if we continue to meet these metrics.
So I'll just add real quick that out on the market, it's running around 6 for other organizations, and where I worked at prior to here, it was 12%. So the 1.5 is phenomenal, and we need to try to help share with our employees that it really is a good plan.
Are the metrics gonna change any in next year, or are they gonna stay the same?
70% done by the end of July.
About, for like pre-diabetics or disease, chronic
They
disease?
put that on hold for this year. They're making a determination next year once they can figure out how we actually have a mechanism that we can control that percentage. So they suspended that from being a metric that we need to use this year. Okay, so we're gonna jump over to page 6. So
Year 2.
the dental plan, we wanna maintain the same vendor with Dental Select. But we want to look at enhancing this plan slightly by adding in two significant enhancements on the Platinum plan. One being adding the coverage for implants, 2 being the coverage for adult orthodontics at the same annual rate of $1,500. So this would, as you can see on page 6, the estimated costs, I believe, are going to be changing slightly. I've asked for a little bit tighter review on the orthodontics. I think it'll be a little more popular in the first and second year. Now, that being said, we're not looking to increase the cost of the plans to the members. We're currently running at a surplus. The dental reserves are running at over $156,000 right now. The recommendation, or we require a minimum reserve of $84,000 in our dental plan. So we basically would do these enhancements, you knowing that we would start utilizing that excess surplus of $72,000, reviewing after a year and seeing if we need to do any adjustments on rates or look for additional enhancements.
So, just to add on to that, we, sent out a survey. It was informal, but we did get a lot of feedback that these were items that employees really wanted to see enhancements to the dental plan.
Are these figures accurate, though? I guess it says on the one page, only 51 said yes and 49 said no. I mean, to me, that's not an overwhelming support for,
Where is that?
That's Gallagher's benchmark data that they provided for the public sector. So that when they
Oh,
went and
that's-
reviewed it,
Yeah, that's actually showing what's going on in the marketplace.
that's the marketplace.
Yeah, that's not actually our survey. Yeah,
How did our survey, I guess I'd like to know how the question was asked, because I didn't see the survey. I mean,
we sent a survey out to roughly 100 of the most recent employees, and we specifically asked what, in the dental area, what benefits they wanted to see improvements and enhancements on.
this
Those
is to
were-
new employees?
Correct, within the last year and a half.
And was it an overwhelming response, or was it yes, just yes or no? Would you like to see this, or yes or no?
Yes.
Or do you say, if we were gonna increase the benefits, what would you like to see? And give them a choice, crowns, root canals,
Really, these are
orthodontia,
the-
adult
These are the only
implants.
two benefits that are not being covered.
At all, I know. I just wondered if,
Yeah,
it seems like to me
well-
we eliminated a lot of possibilities that employees may wanna look at, but if we just asked about two possibilities.
We asked about three. We asked about out-of-pocket maximum, or the annual maximum. We asked about implants, and we asked about, the adult, orthodontia. And the reason why we asked about those three is according to, Gallagher, everything else is already in the plan.
Right, it's just that it's not, you
Maybe
could
the rate-
increase the benefits.
Correct.
On those as well.
Yeah, and that's a really good point you bring up, and, we just need to decide whether, these are the items as indicated that are important to add as new features.
So if you add these, is the annual limit gonna go up?
Not this year. That's something we can look at in the future year. We'll keep it at the $1,500 for the platinum plan.
Yeah, we had
Right,
actually,
'cause-
we had actually asked for it to go up, but we didn't wanna see our rates go up. So, we wanted to see what happened over the first year to see if we could just maintain our current rates and keep the surplus covering this, which Gallagher thinks we can do. But that was the next thing, is to raise the the annual maximum for 1,500 to 2,000.
Right, because, when you think about it, these are pretty expensive
And
items,
the orthodontia would be a separate benefit from the annual maximum.
would it?
Yeah.
But implants would not.
And implants would not, it would be covered under the general.
What is the limit on the orthodontia, do you
It
remember?
would be 1,500, we'd keep it the same.
Oh, you would?
So if it costs $5,000, the plan would pay $1,500 for it. Which, right now, the benefit's not there.
It's just a little ironic, we're adding these two new features, but the limit doesn't go up, so would you ever even be able to take advantage of it?
That's a good question. There was support over raising the limit to 2,000, but, again, there was more support for not increasing any of the premiums, and I think the intent was not to increase the premiums, but the county also doesn't want to increase their share.
It's just keeping the same provider then.
Yeah.
That is what, everything that's helped on the network, that's kind of the best option.
Is there anything in our contract with them that requires an EOB from them within a certain period of time? That's been my biggest complaint with them. It's months,
I mean, the
it's
timing
months
isn't good.
before you get an EOB.
I could ask our representative if they have any issues, I'm wondering if they're more on the provider side, but then it's not even claimed.
Yeah, I think the dentist gets it in, it's in their system, but by the time they actually put an EOB online for you, because they won't mail them out anymore, it's months.
I can take that feedback and see what kind of response I get on their response time to posting.
So why don't, just for a second, why don't we just, talk about the dental? If, we could get the annual max increase, would that be more, favorable to add those items? Is that what I'm hearing? Or is it,
So for the cost of $40,000 roughly, It'd be nice to know if you could get that would cover an increased benefit to $2,000.
I know, it's,
It actually,
If it would, it's probably worth more to most of the employees.
yeah, it actually goes up from 39 total to, I think it was about 70 grand.
To go up to.
Yeah, to go up to the 2,000, yeah. So there is an increase in cost, but what, Gallagher wasn't sure about is if it would actually result in an increase in premium or not, because we are self-funded. We pay for the actual cost of
So
services.
the first year at least, we'd be covered with the surplus that's been developed.
Correct.
The second year, there could be an increase possibly.
If we add the increased out of
It's hard-
annual maximum.
It's hard to speak against adding additional benefits. I mean, that's good, any way you look at it, so.
to me, those benefits are almost meaningless if you don't raise the limit. To me, the limit is more important than adding those two benefits, in my opinion. Because you can't even get to those with normal dental procedures at only $1,500 a year.
You would have to be strategic.
You would have to be very
Do it
strategic.
at the end
Plan
of
your
one
dental
year, at the
problems,
beginning
yeah.
of the next year.
I'll do one implant this year and one next year. And I don't know, to me, that just looking at it.
You do.
But in
especially
dental,
family.
you've got that limit that,
But that is for each one in your family has their own limit. Did you know that? Each member of the family has their own limit. So it's just throwing that out. Yeah, it's an
So
individual
the only
limit.
concern doing all three enhancements would be kind of a rush on the bank situation. So that
Yeah.
first year,
Oh.
surplus really, really went low and we had to make a quick change to increase the rates in the following year. If we keep that annual limit at 1,500, improve the coverage, we can kind of monitor and see the usage. We can see what kind of surplus we'll have at the end of the year, and if it seems like an underutilized benefit because of that, then we can move forward with the option to increase the minimum limits in 2021.
any reason why you surveyed the new employees versus the current employees?
Yeah, that was me. The reason why we did that is we were trying to also find out how we can improve onboarding.
Track.
And trying to look at how we can bring on new employees who may have seen other plans, other dental plans that are richer. Now, we can't do anything with our medical, right? We're fixed on that, so we didn't ask really about medical, other than the fact that, do you understand and share? But dental was the one thing that looked like we could enhance without really spending much more money and really, set ourselves apart. Even though it's just a dental plan, we would have one of the better dental plans in the marketplace if we did this.
Assuming no one uses it, we'd be able to afford it.
We would be awesome. I can tell you, there's a couple in my family that would have implants right away. But yeah, that's why we limited it to newer employees, is we're looking at how to attract people. And we're going to do some other surveys later in the year that will include everybody.
So as you see, the first recommendation is the implant coverage, and we built what on the back. Three real recommendations.
Okay, let's go ahead and go forward, and at the end we can decide whether or not we want to go forward with that.
Vision, as you'll see on page 9, we went out to the market and looked at other vision vendors other than IMED. And the recommendation provided by Gallagher and supported by me also is the VSP network, which the Utah goes through Educators Mutual. Now, IMED, as you've noticed, in our last 3 vendor fairs, have not had a presence here. They don't provide any kind of on-site support for that. IMED goes through the Eyeglass World, the America's Best type
Lens
services,
crafters.
where VSP is more through ophthalmologists, and then also opened up an avenue for our employees to get services at Costco, which that probably was another one of the number 1 recommendations. And the good news about the switch from EMI Health to the VSP network was it's net 0 on cost. And I think you can see that on page 10. There's some different proposed plan options, but it's not going to cost to switch plans, and you can still have the same type of benefits. For vision, just having much better network and cost overall. But it is a new vendor. There are some additional costs that are involved with the workday system integrations. We're trying to narrow down some of that as well. But they're going to provide small implementation credits for helping offset that. But the recommendation for us is to switch from med over to the TSP. That's our recommendation. Less than two.
Anyone have any questions on that? Now, just to add one thing, it would also include, frames annually instead of every other year. So it's actually an enhanced benefit for the same cost. It's a better benefit.
And then the third thing that we looked at was our short-term disability plan, which we just recently switched over to Voya. There's actually 3 other options with Voya. And so we looked at that one more time. We have a few options here, but as they looked through some of the different vendors out in the market, one of the best options they came up with was Mutual of Omaha. And you know Mutual of Omaha because they currently take care of our life plan, supplemental life, and also our long-term disability plan. So there's actually some significant improvements if we have short-term disability and long-term disability through Mutual of Omaha when it comes to claims going through the system of there. Also, one thing that we saw with Mutual of Omaha, the rates being offered for short-term disability were significantly lower. And I believe, I don't know if that's in the slide deck, you can see that on the second page, or on page 12, you can see the Mutual of Omaha rates, almost 40% reduction in some of the age brackets. So we have a much more affordable plan with Mutual of Omaha at short-term disability. And the one issue we're running into right now, and I don't know how much we want to get into it, our current short disability plan goes up to 90 days. Our long-term disability doesn't kick in for 120 days. So we're looking at which option is going to be the best to use, whether it's reducing the long-term disability option down to a 90-day limit, which would be cost the county, and the cost of that would be an additional $16,000, or increasing the short-term disability plan to cover up to 120 days. So there's no gap between short-term disability and long-term disability. And the one thing we did see on the short-term side, even if we increase short-term disability up to 120 days, the plan would still be less expensive than what people are paying for Voya currently at 90 days. So hopefully that makes sense what I said. My brain works.
They require 15% participation. Do we have that?
And we're at that currently. We have about 94 employees on the Voya plan.
Is that right at
And
15?
that's a little over 15%.
Just a little over?
Yeah, so that's one thing that we could talk about, like what happens if we don't use 15, if you down to 10%. But to get a short-term disability plan, it's even more affordable than what we have now. And Voya was a great change from Colonial Life.
Yeah.
That's something that we probably could get more participation.
Possibly, yeah.
So as you can see, the recommendation on that was to switch from Voya to Mutual of Omaha.
So which is the best, increase the short-term coverage or to,
As an employee, we want to decrease the long-term disability to 90 days.
that's the best thing for employees.
It is, for sure. And it's really important not to have that gap and have the same vendor, so it just carries through. We're, I'm sure you know, we're having issues with someone on FMLA, runs out of FMLA, has this gap period before they go on LTD, and they're just in this no man's land. So it'd be very nice to not have that gap. And again, either way, it's a win, whether we go the 90 or the 120 on the short term. But I think we can make an argument for the 90 days. But if the commission is wanting to be cost averse, we can do the 120, and we're still enhancing the benefit for employees.
Yeah, so on page 13, you'll see that extra cost of reducing the long-term disability is $16,000 a year in addition. Go from a 120-day plan to 90. And as we said, going the other way, increasing the short-term disability plan, it's still cheaper with Mutual of Omaha at 120 days.
Doesn't cost anything.
Than Voya at 90 days. So
We
it's
just don't
still-
save as much.
It's a win-win
Right.
either way. And as you can see, there's a couple of metrics in there that Gallagher throws in there. The public standard, 67% of the public entities that they use have a 90-day plan for the long term. So 180, 120 is a little unusual.
Do we save enough by changing to Mutual of Omaha in the short term to pay the added increase? Long
Well, the reason why we don't is because the short term is a voluntary plan paid by the employee 100%.
Oh, okay.
So it doesn't make any difference.
So some employees would save that.
Right. So it's not gonna cost the employees more either way. They would save some with the 90-day plan, but, it does cost the county if we make the long-term earlier.
Would you asking the county commissioners to kick in a little bit longer?
But,
I mean, recommendation number one is switching the short-term disability to Mutual of Omaha, even if we leave that at 90 days. And reducing the long-term disability plan down to 90 days. That's option number one here. Option number two is still switching to Mutual of Omaha for the short-term disability, but making it 120 days on the short-term.
But overall, more employees are benefited by bringing the other one back to 90 days, because if they don't take the short-term disability, they could still get on the long-term after 90 days.
yes. That's right.
And
Just one more, right?
oh, there is one more. Yes, this one's kind of the no-brainer one. Currently, we're using American Benefits Group for our COBRA, FSA, and retiree HRA programs. This is sort of under the umbrella of NFP. It's an NFP company. So in looking at that, it wasn't really making sense why Gallagher and Wright County are still doing business with an NFP type organization. They went out to the market and they proposed a recommendation for switching over to Discovery Benefits. That is the group that they chose. One, because Discovery Benefits has a they've worked with Workday, they have a very good integration, working with them. They would provide an implementation credit as well, helping us integrate their system with Workday. And the annual savings on administrative fees is the big reason we would like to switch over. So as you can see on page 16, you can see what our administrative fees monthly are for the, that's the FSA portion of it. The administrative fees all go down across the board. For FSA, you can see kind of the total cost savings annually. You won't see that much with the HRA and FSA, but COBRA is really where we get the bigger savings with that. I mean, more significant, I guess. And the other part of, because the savings is so significant with COBRA, Arthur Gallagher, they will pick up the administrative fee cost for the COBRA administration. So that's really where we get the biggest value of switching over to Discovery. But right now, we split the cost 50-50. We go to ABG. With Discovery, our benefits broker would cover the cost 100% for the administration of the COBRA.
This would take effect like first of the year.
January 1st.
Tell me what a retiree HRA is.
The only utilization of the health retirement account that we have currently is for when a Tier 1 public safety officer retires with a URS eligible retirement. The county has a program that they will enhance their medical benefits by offering them an $800 a year HRA. That employee has to basically certify that that's what they want. If they have employment elsewhere or have an HSA elsewhere, that's going to be a conflict.
So it's kind of like an HSA
Correct. But it's, they have no other
for
access.
public safety only.
Correct.
So, the HRA administration, as you can see, the annual is very minimal in cost, but it is cheaper still than ABG. And the same for the FSA. But the COBRA is really where we get significant savings. So it's kind of I can't think of a reason why we wouldn't.
Yeah, we don't. I mean, we do. There's no reason why we wouldn't. So that was really fast, I know, a lot of information. The changes really aren't huge that we're asking for. I'm obviously in favor of these changes, but we need to have a discussion whether or not we'd want to recommend these as a committee. So, thoughts?
They all sound good to me.
Yeah, the only sticking point for me is that on the dental, offering those two without raising the limit. To me, raising the limit would be preferable than even those other two. Your survey may not have come out that way, but that's because I don't know if they really recognize what that limit does to you. I don't know. I don't know what they think when they're looking at that, because that was a question, right? But it came in third, raising the limit.
Interestingly enough, they were all about the same. They were really almost neck and neck, the three.
between the
And,
three.
yeah,
I don't know if we wanna take a poll here amongst us, but to me, the more important benefit would be raising the limit over those other two personally, but I don't know how I don't know how you guys feel.
I would agree, it's just a matter of the money, you know.
well, should we could make it that that's what we would like to recommend if, but we don't wanna stop the other enhancements if the commission is unable to allocate the funds.
Would
that be okay?
Sure.
I agree.
Is there anything, Brian, you have?
I'm gonna substitute the increase or try to get.
There was a lot of interest in implants, quite a bit of interest, so, and again, that,
Implants over the orthodontia?
Is that what you're saying?
I'm saying that increase the limit, to me, is more important than even the implants or the orthodontia. And I think that's what we're proposing is if we can get the limit, go for that, but if we can't, we'll still offer the implants and the orthodontia. Right?
yeah.
Yeah.
Is there anything you wanted to add, Brian?
I was just gonna say on that short-term or long-term disability, so it sounds like you're saying your preference is to lower the long-term to 90, which I think is fine. Again, we have no idea, because that option will cost the county
Correct.
more. I would suggest we do something kind of similar, say that that's our preference to lower the long-term disability, but if the commission feels it's necessary to take costs into account, then raising the short-term would be our second option.
And I think
Our
that,
second
my understanding is that's the way it was presented, option number one and number two, is that right?
Okay.
Yeah, that was my understanding, that would be part of the motion, that it would be in that order of preference.
Bottom line, no gap, right?
Correct.
No gap.
That's
Yeah.
very important. And it's much nicer to have the same vendor on both.
That works.
Okay, does anyone want to try to articulate that motion?
I think Kim does.
Yeah. I guess maybe the motion would be to accept your recommendations with the one change, and that would be to, if we can promote the limit increase on the dental, we prefer that, but if not, we'd stay with your recommendation.
Okay, and also on the long-term disability, is it okay if I add on?
Sure.
So the preference is to go with the 90-day, but if cost is a concern, that we would recommend the 120-day,
For
as
the
opposed to
short
no change.
Isn't that your recommendation anyway, though?
I guess it was. Yeah, I guess I see what you're saying.
Yeah.
Yeah, okay. So I kind of double duty to
So basically, just the recommendation you're proposing, and the only thing we'd add is if we can get that limit up, we would, we would like to increase the limit if the commission would allow it, but if not, it wouldn't affect offering those other two options.
Right.
Anybody want to second that?
Well, I
forward
guess
that
I would
motion.
add that the other option would be to do both.
Right.
Add the benefits and to increase the limit.
Correct. That really was our initial recommendation.
So that would be recommendation number one.
Yes.
Number two would be the limit only. And number three, if you can't do the limit, then just these two benefits be added.
Correct.
Would that work for your motion? Okay.
So I'm gonna count that as the motion. Is that okay?
And I'll second it.
All right, we have a motion and a second. All those in favor say aye.
Aye.
Aye. 6-0, motion passes. All right, anything else for this committee? All right, do I have a motion to adjourn?
Oh, can I just have one item real quick?
Of course.
I just wanted to mention that, I noticed in, some of the articles I've been reviewing with regard to class action settlements, with regard to legal actions taken against, retirement plans and their sponsors. And some of the settlements,
in those litigations have included some specific requirements that plan sponsors include in their plan. And this one article emphasized some of these required changes to plans so that as a means of settling the litigation. And one of those is a per participant fee basis for all record keepers, which is something that we have done over the last year. So I'm just, that's just a reaffirmation that we're moving in the right direction there. So I was pleased to see that. Another is the lowest cost share classes should be utilized, and that's what we've been doing. There's also an indication in one of the settlements that it's the net cost that counts. So if in fact we have revenue sharing from a fund, but if that money is rebated to where the net cost is the lowest, then that's what's important, that's what counts.
That's what we did, that's the
Yep.
levelization piece,
Right.
we have it.
So we've done that also. The final item was with regard to use of participant information data. And I think we've talked about that somewhat, but some of these settlements require that there be no information that's provided, that's utilized by the record keeper, so to speak, to market or sell products unless the participant specifically requests that information.
And that's how our link is set up. We don't outbound solicit.
Yeah.
We have tools and they're willing to, and able to reach out to us if that's possible.
So I just want to make note that those three specific lessons that are identified are items that we have addressed, and I think we're complying with those, including these additional funds that we recently have added. That's one of the items too that indicate that those need to be considered, not just the lowest share class of the retail funds, but the other ones. I don't recall what you call those.
The collectives.
The collectives.
So I'd say the collectives are that best practice, but taking it a step further, which we have as a consultant to say, wait, hey, not all of our plans may be eligible for collective, but we might be able to get one for all of our plans, which we've been able to do. So I'd say that share class, as Kelly mentioned that, if you remember going through that, remember we had the discussion of if we were to move to all zero revenue share, your expense actually went up. So there's a few of those that we kept with revenue share because the net expense was lower with it. And then the collectives are something that I think is fiduciaries to your plan, that's taking it even a step further than what the Department of Labor is looking at, saying, are you using the most efficient available? And this plan and through us as we're saying, hey, we're not only are we doing that, but we've actually created an efficient share class that most of our plans wouldn't have access to, but can if we can do collective pricing, which we do. So
anyway, I just want to make that comment that I think we're moving in the right direction, have moved in the right direction, and
The only question I had is you mentioned lowest fee.
lowest net fee. So with regard to the share classes that we have, we have some that still have revenue sharing, and they don't criticize that if that's refunded to the individual participant who has invested in that fund, so that the net cost is still lower than it would be otherwise.
And
So
we're
it's-
okay with that?
So the net,
Yep.
and that's what we've done,
Uh,
is set it up so that any revenue sharing goes back to the participant.
Right.
So most of your funds in your plan have zero revenue share, but there were a few instances where the revenue share class was actually a lower expense because that revenue share of Prudential gets it and it goes right back to the
So
participant.
we don't keep it.
So their net expense,
It used to go into your Erisa budget, right?
Yep,
So
but
that- and we-
now it just goes right back to, yep.
Now we are able, we have set up as of July first, that when we collect it, it'll go back in arrears, just like we collect everything. They'll say little miscellaneous, well, it won't be miscellaneous, it'll be a credit from that particular fund, and we collect it and give it back.
But what we're not saying that we go out and search for the lowest fee we can possibly get irrespective of all other criteria.
Oh, no, and that's not what they're saying here either, you want good performing funds,
Right.
but the
I just wanted to be clear on that.
cost is a critical factor and that's the basis for a lot of this litigation, is they have the same investment basically, but it's a different class that has a higher expense.
instead of having the lowest expense, net cost.
What you're seeing the court say is, they're saying, hey, if you're a fiduciary for the plan, you can't simply say, well, I didn't know there was a cheaper share class available, and I didn't use it. What they're saying is, that's not a defense. So they're expecting plan fiduciaries to say, I understand what the costs are. I also have looked and can show that I have a process to look and see if we're using the most efficient share class available for participants based on the size and scope of our plan,
Which is what you help us
which is
do.
what we do every 12 to 18 months.
Right. Okay.
Yep.
Sounds like we're on the right track. Well, that's great. It was good to read that and be able to check off those items and say, that's
Yeah.
what we're doing.
Yeah.
Yep.
That's awesome. Okay, anything else? Okay, motion to adjourn.
So moved.
Second? Oh, that's it? Okay, I second it. All in favor, say aye.
Aye.
All right, let's go.
Let's go. Go, go, go.